Another day, another week, and probably for many months. It does take us to our talk of the tape, how to play the markets right now as the Santa Claus rally ends and investors position for whatever a new year might bring. Let's ask Josh Brown, CEO and co-founder of Ritholtz Wealth Management. He is with me here at Post 9. All right, so 2 days of red in a row. I said we had some buying of mega caps. You had to believe at some point investors are going to look at declines in those stocks and say enough's enough. Enough is enough. The best stories in the market, and those are the best plays still.
So I agree, and we talked yesterday on the half about just like why are people selling? Obviously, nothing fundamentally changed. People have massive gains in these stocks, especially if they held them through the fourth quarter. And if they did that and they were waiting for an opportunity to take the profit, I'm on the wealth management side, so I already know the way financial advisors think, the way high net worth investors think is, all right, we're going to take 10% off the table, but why would we do it in this fiscal year and owe the taxes in April? Let's push that decision a little. Let's push that tax liability a little bit further out without taking significant risk. This first week of January, after a massive, very sector-specific rally in the market, makes perfect sense to see profit taking. I also think there's a lot of rebalance activity. You combine those two things on the scale of trillions of dollars, that's how you get these stocks start the year looking like they're stumbling, but really, fundamentally, their businesses are not stumbling.
Let's talk about this a little bit deeper, because Tony Pasquarello of Goldman Sachs, head of hedge fund client coverage on this program a lot, just sent a note out before we came on the air, and it plays right into that story and the question that all of you want answered, right? Because he's thinking the same thing all of us are.
Yeah.
Is mega cap tech a consensus position? Of course. Is that a problem? Not necessarily. Here's what he says, quote, a set of stocks that are very well owned and dearly valued. Okay? Now, I would argue these are the best balance sheets on planet Earth. They are generating and returning an immense amount of capital. They have the most direct leverage to the most attractive new theme. Where I come out, continuing to quote, these stocks are not cheap and they are widely held. So one should be a little choosy on adding length up here. Bigger picture, however, I'm inclined to keep my eye on the ball and would look to add on meaningful dips. Now, 1 day or a day and a half doesn't make a meaningful dip, obviously.
I'm with you.
However, the point is clear. These stocks went up the way they did for a reason, and they're going to remain in favor for a reason.
Look, I happen to think Alphabet and Amazon are two of the best stocks to own for this year. I don't love the valuation. Do I wish they were 10 turns cheaper on PE? Of course I do. But these are the cards in front of us, right? We don't always get to pick. I think these stocks will be very stable this year. I don't know that they'll outperform everything in the way that we saw big cap tech last year outperform everything. But I think they can work because they are two of the biggest beneficiaries of AI. This is the year that AI goes from a concept to an actual product. Microsoft's got an early lead, but I think when you look at the ownership of Anthropic, you look at Amazon now using their own chips to train large language models, you look at Alphabet's opportunity to incorporate these tools into all of their existing products for literally hundreds of millions of people on day one. These are companies that are going to benefit, and I don't think they're so expensive that we have to look past them on a valuation basis. So maybe it's not as great of a setup as it was last year. I still want to be there, but I want to be in other places too. And I think you don't have to choose. You can do both things at once. Energy got off to a great start this year. This is the third worst performing sector last year. This year it's in the lead. XLE plus 3%. There's no reason why that couldn't continue, and actually crude caught a bid today. So there are other things to do. It's not Amazon or energy, in my view. It's Amazon and energy. I think you want to look all over the world, quite frankly. There's a lot of value elsewhere.